Morning, everyone. Welcome to end of week Ainsley News. Market crashes in September. History's lesson. I've seen a fair few of these, and today we're going to go into detail about them. As we sit here now in September, statistically the worst month of the year for shares, and coincidentally with share markets at all-time highs, investors should be taking a step back and objectively assessing the situation. Winston Churchill famously paraphrased philosopher George Santayana when he said, "Those who fail to learn from history are condemned to repeat it." The last time share markets got to such distorted highs was the dot-com bubble in 2000. So what does history tell us? Crescat Capital's latest investor research letter talks to this in their useful, insightly terms. This so-called tech bubble actually only had 3 tech companies in the top 5 market cap companies. That was Microsoft, Cisco, and Intel. The other 2 were GE and ExxonMobil. As you can see from the chart we're going to show you, only one of these, Microsoft, remained in the top 5, but after it fell 65% and took 16 years to get back to its December 1999 high. One lesson is that companies that have such exponential growth measured against the reality of GDP usually cannot sustain that indefinitely. Over the 2.5 years of that tech bust in the year 2000 to 2002, the S&P 500 index declined 49%, and the Nasdaq Composite crashed 78%. As a reminder on some basic math, when something falls by 50%, you need to make 100% on what's left to get back to even. Here's this chart here showing the tech bubble back then and also where we're at now. This next chart we're going to show you also make up the top 5 now and how that sits against the year 2000. As we already know, they're called FAAMGs or FAMGs of Apple, Microsoft, Amazon, Google, and Facebook. Combined, just 5 companies now account for over a third of the entire US economy, or 37% of GDP. For context, that's 54% higher than what was for the top 5 at the 2000 peak. Is that tech bubble now for comparison? There's a wise saying, not doing as they say, do as they do. Bill Gates resigned as CEO of Microsoft at the very peak in January 2000 and retired the richest man in the world. Just last month, Jeff Bezos retired as CEO of Amazon and is now the richest man in the world. As Crescat warned, because of the COVID-19 pandemic, in the last year and a half, businesses and individuals were forced to pull forward technology spending and accelerate their move to the cloud to accommodate remote work. The record fiscal and monetary stimulus as a percentage of GDP gave them unprecedented ammunition to do so. Naturally, this has unsustainably boosted the revenue, earnings, and free cash flow growth, as well as the profitability for all 5 of these already gigantic firms. This is the fundamental problem. The fact that 4 of these companies are also in the crosshairs of 6 antitrust bills initiated this year in Congress is yet to add another eerie parallel to the 2000 era. Looking more broadly at the total market, the picture is equally alarming. The whole US equity market is insanely overvalued, with the total stock market capitalization relative to GDP far into record territory, as we're going to show next. Many other broad market valuation measures are also at historic levels. Index investing is also highly popular today, offering apparently low volatility and high returns by hopping onto the momentum train. But it is high risk and large downside return ahead in our analysis. Here's this chart here showing America's biggest stock market manias and where we are now. Gradually, we're seeing more and more people realizing what's happening. Such statistics as 40% of all US dollars ever being created in the last year are just too big to ignore. Hence, too, the market's preoccupation as to whether the Fed will taper or not in the next couple of months. For the first time since the 1970s, the sense of fiat currency erosion relative to financial assets and consumer prices due to misguided policies has penetrated the mindset of investors in a significant way. Global monetary debasement is now setting the stage for a rude awakening. The inflation genie is out of the bottle, and policymakers are unable to sustainably ease off the liquidity pedal. Financial repression has become essential to secure the health of the economy at the current levels of overall debt. Nonetheless, easy and cheap access to capital has always been one of the key reasons for the historical disconnection between asset price and fundamentals. In fact, the sheer amount of financial assets today that trade at near record multiples is truly concerning. Preventing a collapse in risky assets has become a true policy constraint for monetary authorities. Different than other times in history, the Fed's ability to allow the cost capital to substantially rise is incredibly limited. Ultimately, policymakers have their hands tied and will be forced to counter deflationary pressures in financial assets with further liquidity. Igniting an inflationary environment is the path of least resistance. To use the US stock market as an example, the 5-year cyclically adjusted earnings yield is now all-time lows. In other words, investors are undeservedly paying excessive prices relative to bottom-line fundamentals. Going back over a century of historical data, such depressed earnings yields have always led to very significant market meltdowns. The Great Depression, the 1937 to 38 recession, and the 2000 tech bubble. For every one of these periods, the market unexpectedly reversed from very bullish multi-year trends with an average subsequent 3-year performance of negative 53%. Here's this chart here showing the S&P 500 5-year cyclically adjusted earnings yield, and where we're at and where we've been. So apart from the Fed tapering, what could be the catalyst for impending sell-off? Crescat again point to China. Among the important exogenous risks to be aware of, it would be China. The recent crackdown by the Chinese Communist Party on domestic companies could easily spill over significant economic deceleration in the rest of the global economy. Asian stocks and the MSCI World Index have had a very strong correlation over the years. It amazes to see this number of folks choosing to ignore these market risks as being independent cases led by the Chinese government. However, what most forget is that the Chinese economy is far from being isolated from the rest of the world. In our view, this major decline in Asian stocks suggests a systemic sell-off in global equities ahead. Here's a chart here showing Asian versus global stocks. Look how they correlate so closely back to 2013, and we've seen that massive disconnect there right about now. We wrote earlier this year of Crescat's conviction that inflation is not transitory, as the Fed would have us believe, but rather structural. That belief has also had them extremely bullish on commodities, which is normally flourish in higher inflation environments, as they've previously outlined. And whilst commodities have had a strong run on the reflation trade since November, we haven't seen the same performance in precious metals. Most commodities have rallied strongly since November 2020, leaving gold and silver behind. However, we not only have an interesting setup for precious metals relative to money supply, but also relative to other resource assets. Gold and silver are now at their cheapest levels relative to other commodities since 2009. This is a very interesting technical, fundamental, and macro setup. Keep in mind that the other 2 times this ratio reached such depressed levels marked incredible buying opportunities. Here's the precious metals to commodities ratio chart shown here. Technically, both gold and silver are looking poised to break out. Gold is also forming a very bullish monthly candle after a major reversal. Here's this gold chart here for monthly candles, so you can see some perspective all the way back here to 2017. The long-term chart of silver continues looking better over time, and we believe it's poised to move much higher in the following months. Here's silver charts here too. Just to finish it off and leave Crescat for a bit. Earlier this week, we saw the legendary George Soros warn of the Financial Times of a Lehman moment ahead for China. The largest residential property developer in China is Evergrande. Evergrande has over 300 billion, and that's not a typo, of debt, and is struggling with plunging revenue and poor longer-term demographic trends. This prompted Soros to warn Evergrande that it is over-indebted and is in danger of default. This could cause a broader market crash. Beijing also implicitly stated it will not bail them out either. Incredibly, overnight, even the company itself gave this stark warning to its investors. The group has risks of defaults on borrowing and cases of litigation outside of its normal course of business. Shareholders and potential investors are advised to exercise caution when dealing in the securities of the group. This is potentially where the bubble meets the pin. Wow, thanks for joining us for news today, everyone. It was a long one. Perhaps you've enjoyed a coffee or a cup of tea while we talked. Remember, jump over to ainslieBullion.com.au for all things physical, ainsliewealth.com.au for all things crypto, and goldsilverstandard.com for our own crypto built and backed by real gold and silver and stored at Reserve Vault. Enjoy your weekend, everyone, and we'll catch you on Monday for more news.